constitutes dividend? Any answer? So we know there could be a disalignment of the definition of dividend under the Act and under the treaty, and therefore it is very imperative for all of us to understand the definition of dividend under the treaty if we were to avail the advantage of treaty benefit, and we'll see soon how it really impacts. So dividend is income from shares. Let's not wait for it. There are different kind of shares, and if there are different kind of shares, income arising therefrom, should it constitute dividend or it should not constitute dividend? I mean, OECD model uses so many French words, becomes extremely difficult. Jouissance share is a share which gives a right to vote and or right to share profit or liquidation value. It may not give even right to vote as well. So those are very peculiar kind of shares in our different countries. So one needs to be very careful in terms of the word, the term, the way it has been defined could constitute shares, and therefore the security which we are evaluating, we need to identify whether that will constitute as a part of capital or it will not constitute part of capital. In case of LLP, which we may come to a conclusion that it is a corporation, share of profit could be termed as a dividend. So one has to be a little bit careful in terms of what will constitute dividend, what will constitute shares, so that any appreciation realized thereon could be regarded as dividend. Some treaty do have terms like income from other corporate rights being regarded as dividend. Very important point. I think we'll see in some time how in real life this acts or creates a difficulty. Distribution by cooperative societies will be regarded as dividend. You are just a member, not a shareholder. Company limited by guarantee, income arising therefrom could also be regarded as dividend. Issue of bonus shares, and while I was talking to Paresh Bhai, he mentioned it to me that US law says that bonus shares issued by US company is regarded as dividend in US. In such a case, what if any Indian company receiving dividend from US company or bonus shares received by an Indian from a US company, how it has to be taxed in US and in India? In US, if it is being taxed as a dividend, do I get a credit for such taxes paid in India? But bonus shares are not regarded as dividend in India. Under the Act itself, it is not taxable. Why should I go into the treaty and see that it gets taxed as dividend? So one has to be really careful how we are interpreting the definition of dividend under the treaty and under the Act. And since India has an ability, or a taxpayer has an ability to choose treaty vis-a-vis Act, whichever is beneficial, one should make effective use of it. Let's take an example. So far I have been delaying this, but let me take this example. A foreign company has Indian company and Indian company 1. Indian company has surplus, undistributed profit which are available for distribution. However, without declaring a dividend, It just advances loan to Indian company. Various issue arises. Whether such advancement is considered as deemed dividend under 222E or not. I think we have already seen it will be, right? If it is a deemed dividend, in whose hand it should be subject to tax? Should it be in the hands of ICO 1 or should it be in the hands of FCO? Somebody said ICO, so how many people are agreeing to ICO? Sorry, ICO 1. None? FCO. I think who is the shareholder? FCO is the shareholder, so it can at best considered as dividend only in the hands of FCO. Now, if FCO is subject to dividend tax, whether FCO can avail the benefit of treaty. So treaty is not available, right? Any specific reason why?
It's a deeming provision, not the actual dividend paid.
These taxes are not covered. Taxes are not covered.
Okay. Whether it fits in the definition of dividend under the treaty or not. It does or it does not. And therefore we have to look at the definition of dividend. What if definition of dividend includes other rights?
Still not paid.
Yeah, but whether it is dividend or not at first place. Payment is secondary aspect. So then one has to really read the definition of dividend to decide whether it will constitute dividend for article to trigger or not. It may, if it includes other corporate rights like loan to another subsidiary, in such a case it will constitute dividend under the treaty and one may be able to avail the benefit of treaty. Otherwise, under the domestic tax law, it could be taxed at a much higher rate. So one may want to see that it should get covered under the treaty. What if there are no treaties? In such a case, obviously it will be taxed at 42% if it's a foreign company. Yeah?
Possibly corporate rights will be debated if ICO were to have a different shareholders also in addition to the FCO. Because then the loan made to one party and the no distribution to the
Other shareholders may not constitute corporate right.
Correct. Then only to the proportionate of their investment it could be construed as a dividend. So there is a way where department would like to tax it. However, the another aspect which was brilliantly brought out, whether it is paid or not. Can we say that dividend is paid to FCO? As we have discussed earlier, that word paid, you please pay attention to that word. If it is not paid to the FCO, can I take a view or a position that it is not taxable? However, can department say that it should be part of other income in such a situation? So therefore, article dealing with other income, it should get covered there. Any thoughts around that?
The general principle is that once it is covered in a particular article, if it is not included, if you cannot go to another article, that's a general principle.
Absolutely right. Absolutely right. So if it is covered within the definition of dividend, in such a case, other article will not trigger. In that case, it is imperative for us to understand this treaty and how to read this treaty. because just isolation reading of this article doesn't help. I think we need to read it from a holistic point of view. Now I'll give you one example how dividend gets classified under other article. A person, a US citizen, he becomes an ordinary resident of India, derives dividend income from US, and under the tiebreaker rule, he qualifies to be a tax resident of US. How does dividend article deal with it? If we read the first article, it talks about dividend arising in the state of source will be taxable in the country of residence. Here, the person is a resident of US. Dividend is arising in US, but because he is an ordinary resident, under the domestic tax law, it will be subject to tax in India. So, dividend article does not deal with such a situation. In such a case, can we say that instead of dividend article, we can consider other income article and try and see how tax or benefit of double taxation can be enjoyed? I think it's a food for thought. We will not deal with it, but certainly I think one needs to really look at it from that point of view as well. Paragraph 4 deals with dividend which is arising on account of permanent establishment shall not be able to avail the benefit of this article. Tell me in which situation a dividend can be attributable to in which situation one can say that dividend is arising to permanent establishment and therefore it is not covered by this article. I think if you have seen Pareshbhai's material, it is very well defined. Citibank US has a branch in India, has advanced loan on hypothecation of some shares. Loan remains unpaid. In such an event, shares are being transferred to Citibank, and then Citibank earns dividend, assuming that dividend is taxable in India and there is no DDT. What would happen? Whether Article 11 would apply or we have to go to Article 5 and 7. By virtue of paragraph 4, we have to go to Article 7 and not Article 10. So basically, this is nothing but for limited force of attraction rule, that anything which is effectively connected with a PE, that should be regarded as a business income. I think it is not different from FTS, it is not different from any other such article. And therefore, any income which is arising effectively connected to a PE will be regarded as income of PE and it cannot avail the benefit of any other article. And this is what it tries to say. Why we are spending more time? Because then we have to deal with interest, and that also covers the same principle. And probably we may not have to spend time then. So while dividend may not be relevant, please pay attention. I think force of attraction we have dealt with. This is very, very interesting. And it took time for me to understand this. Where a company which is a resident of India, I am just making it a little simpler than what is being written there, derives profit from UK and distributes that profit, will it be subject to dividend tax in UK? Let's take an example in a little different manner. Indian company has a branch in UK. Profits are there in UK. Declares dividend out of the UK profits. Will it be subject to tax in UK or it will not be subject to tax in UK? Can we say dividend is arising in that country? Are there any such companies in India? I think there was one. Unilever had a branch in India which used to declare dividend in India. Whether such dividend was subject to tax in India or not? So by virtue of this article, it is not subject to tax because it is just a distribution of profit of a branch. That does not mean dividend is arising in the country where profits are earned. Dividend arises in a country where the shares, situs of shares are there. This principle is affirmed by this paragraph and it clarified to different countries, given that different country may have a different law of taxation. And these are the situations which this article tries to cover. However, it goes ahead and says that if dividend is received by a UK resident, in that case, that dividend is still taxable in UK. Similarly, likewise, we have taken example of Citibank in India. If such dividend is received by a PE in UK, then such dividend will be taxable in UK to the extent it relates to the PE in UK. I hope this provision is very clear to you. Please ask question. I spent around 3 hours just to understand this and explain it to my team. Okay, what it means. Any doubts? Any questions? Let's take certain treaty scenario, how these are worded differently from the normal treaties or the provisions which we have gone through. So India-Canada treaty taxes other rights as well, where you have to think of dim dividend and how it will, whether this article will apply or not. If we look at India-Greece treaty, the taxing right is only with the source country. So the country of resident do not have a right. So if any dividend declared by a Greece company will only be subject to tax in Greece and India would not have any right to tax that income. So we will take a break for 10 minutes and we will reassemble here. Thank you.
Chandigarh.